Good morning, traders. Welcome to the week ahead preview. My name's Aaron Hill, and I'm the head of research here at FP Markets. So, with another week in the rear view mirror and a packed docket ahead of us, particularly in the US, we have plenty to get our teeth into. The non-farm payrolls report will be a key event to monitor on Friday. Now, the US economy, as you can see here, is expected to have added 130,000 new jobs in April. This is down from the 228,000 added in March. The estimate range is currently quite large, and this is between 160,000 and, sorry, excuse me, 170,000 and 50,000. The unemployment rate, as you can see here, is expected to remain unchanged at 4.2%, while month-over-month wage growth is also expected to remain unchanged at 0.3%, while the year-on-year wage growth number is expected to rise by 3.9%. This is up from 3.8% in March. Now, heading into the event, heading into the NFP event, it is worth noting that the unemployment claims have been stable around the 220K mark, with the 4-week moving average slightly moderating in the week ending the 14th of April. And continuing claims, as you can see here, also taking a modest hit. Now, look, we also have service sector jobs. Service sector jobs rose modestly in April, and manufacturing jobs were also cut for the first time since late last year. And this is according to the latest flash PMIs. Look, overall, in terms of the I've not really seen much impact from tariffs on the US jobs market, and really, right now the jobs market is still okay. So, if we see the non-farm payrolls print come in line with expectations at around 130K, or even slightly higher, at say 140K or something like that, this helps reaffirm the jobs picture and could lift the US dollar, also lift US yields and of course the US equity space. Now, a bad number, of course, would have the opposite effect and could weigh on these markets. Now, something to bear in mind for anyone that does follow the COP data, that's the commitment of traders data. It does show that the US dollar is stretched quite severely to the downside at the moment, and therefore an inline data print for the NFP here at 130K could see some of those short positions unwound and help longs get more bang for their buck, if you will. One chart I am particularly closely following at the moment is the S&P 500. This is as you can see, the daily chart here. And this may interest any harmonic traders that are watching. So following a low of around, I think it was 4835 on the 7th of April, which touched gloves with this alternate AB equals CD pattern. This is essentially a 1.2%, 1.272% Fibonacci projection ratio at 4983. We have seen a nice rebound from this level in the form of a potential equal AB equals CD pattern. And this terminates around the 100% projection ratio of around 5, I think it's 5746. But what's interesting here is this is also accommodated by the 1.618% Fibonacci extension ratio. This was taken from point B to C, so extended from point B to C, and then the 1.7618% Fibonacci extension ratio was found at just around 5, I think it was 5718. As well, we also have a 61.8% Fibonacci Fibonacci retracement ratio in play here as well, and this is at 5652. So within this area, we have a potential zone of resistance to work with. In addition to this, we also have the 50-day simple moving average and the 200-day simple moving average converging with this area. And do note that we have just recently seen the 50-day SMA cross below that 200-day SMA, indicating what many technical analysts may refer to as a death cross. And all this really suggests is that a longer-term downtrend could be on the cards. So with this in play, I do expect further upside in the S&P 500 in the short to medium term. Short term, I would say, but medium term, I'm really looking for a nice reaction from this S&P from this resistance zone between 5718 and 5652. Yeah, just something to bear in mind on the S&P 500 at this currently playing out as we speak. So moving to Wednesday, this is the 30th of April. We have the advanced GDP data for the US being released. This is for Q1 2025, with the economy estimated to have cooled 2.4%. This is down from 2.4% in Q4 24. Just take a look at the estimate range here. This is between 1.7% and minus 1.5%. It's quite a large estimate range. And what this really tells me is that there's quite a lot of uncertainty heading into this. The market participants have heading into this data. Something else to bear in mind with this data is that it is lagging. We're essentially getting the data from Q1 of this year, but we're already approaching the beginning of May. And bear in mind, guys, this is also only the first estimate. There are three estimates to this GDP print. So there's the advanced estimate, there's the prelim, and then there's the final. So yeah, but this will be a widely watched event. I believe it will be a widely watched print for the simple fact that growth is a concern right now amid tariffs. And the first estimate of US GDP will likely show some of the anticipated impact of trade tariffs that were experienced in Q1, hence the marked slowdown, I believe, that's forecasted. Something else that I feel that's really worth taking into consideration is the Atlanta GDP Now model, showing that the latest estimate for Q1 25 growth is currently running at an annualized rate of minus 2.5%. Now, if you take the adjusted model, which accounts for imports and exports of gold, this is currently running at minus 0.4%, which if you think about it, is more in line with the economist estimates of 0.4%. So yeah, look, if we get drastically lower than expected data, I mean something like a minus 1.5% or a minus 1%, then we can expect some downside in the US dollar, some downside in US yields, and of course the equity space as well, as investors look to reprice those rate cut expectations. Look, if we get a higher than expected number this week, this could really underpin those markets. Another print I feel that's really worthy of the watch list this week is the ISM manufacturing PMI. As you can see, economists are estimating that we will come in lower in April at 48. This is down from March's reading of 49. We do have an estimate range between 49.8 and 46.5 currently. If you look at the flash PMI data for April, this was released last week for April. This showed that growth is expected to slow in Q2, with prices also rising. You will also see that service sector, as I've already mentioned, service sector jobs rose moderately in April. Now, something else I did find that was quite interesting from the Federal Reserve Governor, Christopher Waller, and he stated that he believes tariffs will increase price pressures and lower employment and growth. But he went on to say that the effect on prices could be a one-time occurrence that will pass through. Now, with that, Waller also mentioned that responding to the impact of rising prices is challenging. You will also remember that I'm sure you'll remember actually that the Fed assumed that the spike in inflation was temporary during the COVID-19 pandemic, only to discover, of course, that it was not the case, and they found themselves quite a way behind the curve. Now, as I've mentioned in previous posts, given the impact of potential price increases from tariffs and the effect on growth, this continues to really place the Fed between a rock and a hard place. I mean, Do they lower rates to shore up a softening economy, or do they hold rates at elevated levels to hamper any inflation, any inflation spike? So Waller also, Fed's Waller also went on to say that he does not expect to see much impact in the hard numbers. This is the hard data, guys, until the year's second half. So until the second half of next this year. So the Fed will likely be on the sidelines until a clearer picture unfolds. Look, it's really no secret that the soft sentiment-driven data has shown signs of weakness, but we've really not seen this converge with the hard data as of yet. The Fed meet next month, as I'm sure you're all aware, and it's pretty unanimous. Out of 101 forecasts, only two believe a rate cut will occur, and this is over the 99 that believe the Fed will remain on hold. Look back to the ISM print on this. Apologies for diverging somewhat there. Look, the ISM print for me is quite a tricky risk event to trade. I'm going to try and explain. So last month's data, we had a it really highlighted a stagflationary environment. You may remember that the prices paid component jumped while growth and labor dropped. I think what investors will be watching for here is whether we'll see prices continue to rise and growth fall, or whether things will merge somewhat. As we know, the earlier PMI flash data saw services move into contraction and manufacturing moderately increase. But look, with the manufacturing data, there is an issue with possible front loading of the tariffs, right? So remember, tariffs were announced at the start of April, and the flip-flop from the White House since, which includes the 90-day reprieve and of course the increased rates on Chinese imports. We have to be cautious to the fact that an upside surprise in the headline number, the ISM manufacturing PMI number, may not move the market's dial, may not move the market's needle too much due to the front loading. But it could also be the same for a bad number, right? So with the markets potentially overlooking a downside surprise, as the data will not really account for the recent backtracking we've seen from Trump and the somewhat de-escalation we saw last week. Guys, this is just something to bear in mind, but this is a difficult print for me to personally to trade, and I probably will be on the sidelines for this, just watching how things unfold. Before I wrap things up, do keep in mind that we also have a number of big earnings releases out of the tech sector this week. This includes companies like Amazon, Apple, and Microsoft. So that's it from me today. As always, please like and subscribe to the channel for more videos. Thank you very much for listening, and have a great week ahead.